Buying the dip, when it works, it's perfect. You get to own the stock that you wanted at a cheaper price. But what about when it doesn't work? It's a trap. The risk is you're stuck with a stock that continues to lose value. So today, I'm going to show you how to avoid getting caught in that trap. Hey guys, I'm Jasper, an investor and market analyst in the City of London, working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. You should always do your own research. Today, I'm giving you practical tools, essentially a checklist, so that when you next see a stock dip, you'll have a plan. But not only that, I want you to think about how buying the dip fits into the bigger picture of managing your investments. What is a dip? I put the word dip in the title of this video and you're watching the video, so it seems we both know what a dip is. Naturally, if you're buying the dip, you are doing so because you think the stock will rise again afterwards. What you're hoping for looks a bit like this. A stock has been trending higher. It goes down, but not nearly as much as it's already gone up by. You buy it after it's gone down on the dip, and then it starts rising again, takes out the previous peak, and happy days. Alright, we know a dip is when the stock drops a bit, but by what percentage are we talking here? There isn't really a single universally agreed upon number for what constitutes a dip. I've owned enough shares myself, and while working on Wall Street and in the City of London, I've seen enough clients with everything from shares to currencies and commodities to know that different investors use different thresholds in different situations. There are three specific thresholds that mostly apply to the stock market as a whole. You hear them being spoken about for benchmark indices like the S&P 500 or the FTSE 100. A 5% dip is known as a pullback, a 10% dip is called a correction, and a 20% dip takes you into a bear market. For individual stocks, these thresholds are still loosely referenced, but there's no hard rule. A so-called dip can be 5% for a slow-moving blue chip stock, or easily 20% in a fast-growing tech stock. And both can still be normal volatility in their respective contexts. The other bit of info you need when considering a dip is from which high you are measuring it. The default answer for a stock is the all-time high, and this will often be the case in a bull market. For stocks that have not made a record high in years, I'd suggest benchmarking it over the past year, which in stock market parlance is the 52-week high. The real question is why the price is dropping and whether that makes the stock a good value or a value trap. I'll get into that in a sec. Why buy the dip? It's a simple idea, but does buying the dip actually make sense as a strategy? Well, in a sense, yes, because historically stock markets have risen over time. The logic of dip buying is more or less the same logic for buy and hold. You keep holding a stock because you believe that overall stocks rise over time.
Now just keep holding on, okay? Just keep holding on.
So even if it dips in the short term, you're going to ignore that dip because long term you'll be good. So even though the action that dip buyers take versus buy and holders in a way is opposite, the logic behind it is the same. Stocks go up so I can buy this dip, or stocks go up so I don't need to sell my stocks in this dip. This reflects how some investors rationalize their decisions, though of course past performance is no guarantee of future results. Alright, here you ask, why on earth have you made a video talking about a trap if buying the dip mostly works? Nothing can work all the time, but if it mostly works, that's good enough for me. 6 words. It doesn't have to come back. Just because a stock was once priced at $50 and it dips to $40, there's no guarantee it has to come back to $50. Sometimes it will, but all it takes is one time when it doesn't, and that's the one that gets you. Let me show you what I mean with a popular stock where there were many chances to buy the dip and how things went. I'm talking about everybody's favorite social media company, Meta, formerly Facebook. This is a logarithmic chart, so it shows the dips in percentage terms, not absolute. It goes all the way back from earlier this year, back to the Facebook IPO in 2012. I think you can already see where I'm going with this. Let's walk through a hypothetical scenario many investors may relate to. This is not a recommendation to buy also Meta or any stock. There were 8 big chances to buy the dip, where there's a good chance that if you held on, you'd have made money. Before we talk about the 9th, let's mention the 5th instance of a dip in Meta. It's quite important to the idea I want to share on this. Let's think about how this might have gone down in 2018 on that 5th dip buying opportunity. Meta makes a record high. It's been an epic 5 years since the IPO and the bull market is still ripping. The stock dips 10% and you start thinking about buying the dip. It drops 15%. The stock was hot at $190, so it's a steal at $160. You decide to step in and buy some shares. The shares turn around and start motoring back to the highs. I am a genius, you think. But oh, the stock drops back from the highs. First 10%, then 15%, and you're back to break even on the investment. Then lower, 20%, you think it's okay, I'm still close to my entry price. If I liked it at 190, I must love it at 150. Then 25%, you start questioning your actions. 30%, you're making a big loss at this point and starting to sweat. The dip eventually bottoms out about a 1/3 decline from the high and goes on to make a new record high. This is when you start patting yourself on the back. Wall Street, here I come. But it's important not to confuse luck with skill. Now fast forward to 2022. Facebook stock does something similar. This time, after your last experience, you're a little bit more cautious. You wait for a 20% dip. Again, it drops to 30%. I've seen this all before, you think. Then 40%, then 50%, yikes, then 60%, then eventually 75%. If you bought in the 2018 dip, your unrealized loss is probably around 70%. What do you do when the stock is down that much? That brings me on to my next point about buying the dip. Know what you own. Buying stocks simply because it dipped is not a good reason. You can absolutely buy stocks on the dip, but the dip itself cannot be the reason. You gotta know what you own. For any stock you're considering investing in, and definitely for all stocks you already own, you need to understand their business. If a company's fundamentals still look strong, if you see more demand for its products or services going forward, if it has plenty of cash and a solid strategy, then maybe that dip is just a temporary market overreaction. But if the company is struggling with declining sales, competition from new rivals, regulatory hurdles, or it just never really had a competitive advantage in the first place, you need to ask yourself whether you're investing based on hope or facts. Let's continue with our Meta example. When the shares dropped around 10 to 15% several times in the past, the context was often that user growth or revenue slowed temporarily, the market got spooked, and then the stock bounced back as the company continued to grow at a healthy clip. But in 2022, a more significant set of challenges emerged. Apple's privacy changes hurt advertising efficacy, competition from TikTok intensified, the company's ambitious and expensive shift towards the metaverse spooked investors, and the result was a 70 to 75% drop from its highs. A key difference, a change in market perception of Facebook's future growth. It wasn't just the broader market environment, but the company's fundamentals and strategic direction that made investors question whether buying the dip was truly an opportunity or simply catching a falling knife. The mad thing is, after that 75% drop, Meta shifted strategy, cut some costs, and the stock came roaring back in the next bull market. So, I can add to your confusion here, it was actually a profitable move to buy the 2018 dip. But to invest in a stock after a heavy decline, you need to do your homework to know what you own. Because if you don't, for all you know, the stock could be headed to zero. If you're just buying the dip because it worked in the past, you'll likely panic, sell out of the stock way before the bottom anyone would. So I promised a checklist. Here it is. It's a general checklist that some investors use to think critically about market moves. This is for educational purposes only and not a guide to action. The next time you see a stock in freefall, Ask why. Why is the stock down? Is it due to a short-term overreaction, or is there a structural problem with the company? Also, a sudden broad market sell-off could create bargains even among strong companies. 2. Look at fundamentals. Earnings, revenue, profit margins, competitive advantages. Do these still look solid, or are they eroding? A company that's losing market share or seeing its core product becoming obsolete might not just rebound because it always has before. 3. Consider opportunity cost. You can always put your capital to work somewhere else. If you have a better investment opportunity, why sink more money into a stock whose best days might be behind it? 4. Have a plan. Instead of spontaneously buying the dip, set some rules for yourself. Decide in advance at what price or valuation the stock is a true bargain based on your research. If it dropped below that level for reasons you understand and you accept, you'll buy. If it doesn't meet your criteria, you'll move on. Okay, what are the main takeaways about dip buying? One, I could say it doesn't have to come back. A stock might never return to its previous highs, especially if its fundamentals have changed for the worse. If you're counting on a bounce because it's happened before, you could end up holding a stock that's going nowhere, or even headed further down. 2, I'd say know what you own. Some experienced investors focus on intrinsic value and long-term fundamentals when evaluating price movements. Understanding this perspective can help build a better investing mindset. When Meta plunged over 75%, many investors panicked and sold. But those who felt they truly understood the business stuck around, even added to their position, then the latter were vindicated on that occasion, but may not be in the future. There will always be plenty of times when there is a fundamental problem and holding on doesn't work. The point is not to panic and make informed decisions. 3, we could say don't confuse luck with skill. A bull market can make almost anyone look like a genius. If your entire strategy is simply buy every dip, you'll end up doubting yourself when the stock doesn't come right back. Worse still, one big washout decline can wipe out all your smaller gains you made from prior successful dip buys, leaving you with nothing to show for your efforts.
Please, sir, I want some more.
It's precisely this kind of experience that stops many people from investing properly ever again. 4, just don't fight reality. If the thesis that you had on the stock no longer holds, don't be afraid to cut your losses and move on. Hope is not an investment strategy, and neither is blind faith in a rebound. Alright, that's it for now. If you found this perspective useful, please consider sharing it with friends or colleagues who might appreciate some clarity on buying the dip. And let us know in the comments, what's your personal rule for handling steep sell-offs? Do you hold tight, buy more, cut your losses? We'd love to hear your take. Thanks for watching. Take care.